Kaushik Das now joining us, Director and Chief Economist, India, Deutsche Bank, and really good to have him with us, particularly as we track those crude prices, the impact when we take a look at the bond route, as well as what's happening with the Forex war chest. So many fears that are building on capital outflows as well. So lots to discuss with him. Kaushik, good morning and thanks for being with us. Let's first talk about those higher oil prices and how you see them impact the economy at a time when we're in the throes of a recovery, really.
Yeah. Hi, good morning. I think, in the beginning of the year, people were working with an assumption of about $55 to the barrel for Brent. And that is visible from the median estimate of forecast from the professional forecasters. But in the last few weeks, we have seen oil rising to 70. So it makes a difference for India. If the narrative is oil is at 50, 55, it will be more comfortable. If it is at 65, 70 or higher than that, obviously the narrative will change given that we are a twin deficit country. So normally when oil prices go up, you see the burden being shared by all the stakeholders, mainly three stakeholders. So one is, the consumers will have to bear the burden, and you could see, obviously inflation going up, and we have seen petrol and diesel prices being hiked. The second is government would also bear some part of the burden, and you could expect, excise duty cut related to petroleum products very soon, probably starting from the next fiscal year if oil stays at 70. So the government would also have to take some cut in revenues. And the third is normally, if things go beyond control, if it goes to 75, 80, maybe oil marketing companies would be also, asked to kind of bear some part of the burden. So normally this is the way oil price increase is shared between different stakeholders. So now the thing is, if you look at different elements, India is actually not in that bad a position because in the current account side, normally when oil prices go up, the current account deficit also goes up. So obviously, oil being at 70, current account deficit will go up, but the capital flows are so strong that we'll still have a healthy balance of payment reserves. And also RBI, as you mentioned, has built so much of reserves, close to 600 billion. If rupee were to depreciate because of oil prices, RBI is there to defend the rupee. So rupee would stay very stable, which would be very comforting for the investors. On the inflation front, RBI has already taken a very conservative forecast for the next few quarters at 5.2%, 5%. So that builds in some bit of increase in oil prices, which is also comforting. And the third is, you must have heard after the budget that government was conservative in estimating revenues for the next year. So people were expecting some increase in revenues from different, sub-segments like GST. So even if, the petroleum, the excise duty revenues were to come down, that would not probably lead to the 6.8% fiscal deficit getting breached on the higher side. Probably the 6.8% fiscal deficit could have come down. But if oil prices were to be at 70 or higher, then government would meet that target and you would have no fear of extra borrowing. So India relatively today is in a better position, in a much more resilient position, given the work that RBI has done and given the conservative estimates that government has taken in the budget.
Okay. I come to a very basic point, which is at what point in time do you think both demand and consumption will start hitting us? Oil prices going higher and the benefits are going to be, or the oil impact will be passed on to the consumer. Steel prices going higher and the impact would be felt by the consumer. Food prices going higher and the impact will be felt by the consumer. We all are welcoming the uptick in wholesale inflation, and you rightly said RBI is quite sanguine about the inflation numbers, but somewhere it will start having impact on demand and consumption. How far are we from there?
So I think, Nikunj, if oil prices head above 70, and it's a psychological level, if you remember that in 2018, when oil prices went above 70, RBI was forced to hike rates at that point of time because growth was also relatively better at that point of time and inflation was heading higher. This time the story is different. But to answer your question, any price above 70, and if it sustains and if oil goes to 75, 80, that would be pretty, having a negative impact on consumption because people would want to then reduce some part of the purchases of other discretionary consumer items. So that could become a problem. But I'm certain that if oil prices go above 70 and sustain over there, all the pressure will not be passed on to consumers, at least on the fuel side. Government would take some part of the burden by cutting the excise duty on petroleum products as well. But there would be some growth sacrifice, obviously, if oil were to be at 75 compared to if oil were to be at 55. So we have already taken a conservative forecast for FY22 at 10.5% real GDP growth compared to the IMF's forecast of 11.5%. So part of that builds in expectation of higher oil prices and lower consumption, and still you should get about 10.5% real GDP growth for India in the next fiscal year.
At what point in time, what we are calling as a healthy inflation, it is giving pricing power to wholesalers, to manufacturers and wholesalers, we will start using the word unhealthy?
A very good question, Nikunj. And as you know, in markets, everything is with relative to expectations. So the expectations at this point of time is that RBI's forecast of 5.2% is more or less adequate for the next few quarters. If over the next few months you see RBI revising up its forecast from, say, 5.2% average that they've given for inflation to, say, 5.5% or close to 6%, if that were to come about, then people will start getting worried about the inflationary impact and what it may have on other macro variables as well. So we need to see, first of all, whether oil sustains at over 70 for a long period, or if you have a meeting with OPEC in April, you see oil prices again coming down to 65 and more or less stabilizing in the 65-70 range. But any inflation number above 5.5% in the next fiscal year, when growth is also supposed to improve and you have fear of core inflation moving up, RBI will be very concerned. And as you've heard from the RBI, is that they want to do open market purchases of bonds to keep yields under check. So on one hand, they want to do that so that 10-year bond yields do not go up too much and hurt growth. But at the same time, if inflation is heading above 5.5 towards 6%, then markets will question whether RBI can do that much bond purchases like what they did in FY21 in fear of the inflationary impact. And that could lead to some negative impact on growth coming, because RBI may not end up doing that much OMO purchases.
Okay, sure. So that's in terms of what we're expecting from the RBI as well. When do you see global monetary policy normalizing somewhat, Kaushik, especially from the US, and the kind of impact also of this resulting on equities?
So the thing is, you've seen how US treasuries have moved up. The 10-year treasury has gone up to 160. And market is now pricing in expectations of rate hikes from the US happening earlier than what people would have expected. So probably the hikes will happen in 2023. But the expectations of those hikes are being brought forward from what was expected earlier. And that is leading to a repricing of yields in the market. So the move of US Treasury from below 1% last year towards 160 has been very sharp and in a very small horizon of time. We were expecting US Treasuries to go up to 150 by the mid of this year, but not in the first quarter itself. So we have actually increased our US Treasury forecast to 2% or two quarter by the end of this year. So that kind of says that probably the Fed would be doing the rate hikes earlier than what markets would have expected. And there also in the US, expectations is that inflation could come back. The recovery could be stronger because of vaccination happening, and which has already started. So obviously that would have some knock-on impact on emerging market currencies and emerging market growth trend if the US were to hike faster. But nothing is happening probably before 2023. But the taper talks could start by the end of this year, and the Fed could start preparing the market for eventual rate hikes from the end of this year, is what we expect.
Okay. And in terms of debt flows to India, in amid what we're seeing and the rising yields as well, both globally as well as what we're seeing back home, how do you see those shaping up?
Okay, so I forgot to answer about the equity part. So if yields go up too much and in a short period of time, you normally see equity markets kind of reacting a bit negatively. And, we have seen a little bit of volatility coming in S&P 500. And you'd see that the Indian equity markets are very, very highly correlated with what is happening in S&P 500. So in case there was a, kind of increase in yields which were continuing over the next few months, and you see equity markets correcting in US, there could be some, kind of correction in India also, just because of the correlation. So that factor is there. But from a medium-term point of view, given India's, growth trajectory that we are expecting 10.5% growth, I think equity markets would be doing better than any other asset class in India. So we are positive about that. On the debt side, we have seen outflows continuing since last year, and nothing has changed as of today. What can be a game changer, though, is if the government decides to make this global bond index inclusion ready by the end of this year. If India manages to get into the JP Morgan bond index, that could lead to a lot of flows coming into India, because then fund managers would have to be part of that index, and then next year we could expect a lot of flows to come into India. So in fact, RBI now has a problem of plenty of so much FII flows coming into India compared to the current account deficit. And you have seen how rupee has shown one-sided appreciation pressure since the last 6 to 7 months, and RBI has been buying continuously to build up dollars. So at this point of time, the capital flows are not a problem for India, because current account deficit, even if it goes up, it's under control, whereas capital flows are pretty strong. Only thing is, we have seen this one-sided rupee appreciation pressure, which RBI has tried to defend with buying dollars. That could become a more of a two-way movement, and you could see some bit of depreciation, some bit of appreciation, which actually is more healthy for the market rather than a one-sided move. So we are more positive about the debt flows once the global bond index inclusion gets announced, maybe by the end of this year. And equity flows, there could be some bit of volatility in between, but the medium-term story remains intact of India having a better growth than any other country, and you should expect flows to continue.
Kaushik, closing comments. Any economy has three rates. One is the interest rate, second is the currency rate, and third is the inflation rate. The government, in a sense, you know that RBI is trying to influence, I'm not saying control, influence the currency market. They're also trying to, in a sense, influence the inflation market by managing various bonds. But do you think somewhere while you're trying to manage currency and inflation, the interest rates may just shoot up?
So the thing is, Nikunj, it will not be an either-or strategy. We think RBI will be present in all the markets. They have been, managing the rupee appreciation pressure, because if you allow rupee to appreciate too much, there would be competitive issues. RBI has come out with a report saying that 73 looks to be the fair value at which rupee looks to be fairly valued. So RBI would not want rupee to appreciate too much, because that would have competitiveness issues over the long term. So RBI has done a good job of picking up all the reserves that they can, because if you remember in 2018, when oil prices shot up and RBI had to defend on the other side to stop rupee from depreciating, they lost a lot of reserves at that point of time. So this year there will be no worry. Even if oil prices were to go to 75, 80, you will not worry about rupee going above 75. So RBI can manage that other side of volatility as well, given the reserves that they've picked up. On the bond market side, RBI doesn't want yields to go up too fast, and that is what all central bankers across the world are trying to do, control a soft yield curve control in most of the countries. But as you pointed out, that it is not possible to do all the things at the same time in equal proportion. So we think that RBI will let go. Already you have seen yields going up a bit to 622, 625 on the 10-year. Rupee has come above 73. So I think there will be bits and pieces where RBI will let go of a little bit on the bond yield side, a little bit on the currency side. And, but it will not be the case that they'll let either the currency go completely or the bond yields go completely, and they'll be present in all the markets, which is, I think, the best strategy to have stability in all the markets and not have any shock in particular, either bond yield spike or, currency moving too much on either of the direction.